This is Larry Williams, and I'm really happy and glad to be back at StockCharts.com because I am going to go out on a limb and give a market forecast here, way out on a limb. It's not a bad place to be necessarily. Mark Twain said it best, why not go out on a limb? That's where the fruit is. And I will get back to this quotation a little later on because I'm going to add something to this thing about being out on the end of a limb. So we get out on the end of the limb to see the future, to make a prediction. So I want to point out, how can we see the future? Well, I'm not psychic, but I have some tools, and I'd like to share these tools with you today, and I will be going over them. Those tools are seasonals. We usually have a seasonal pattern in the markets. Markets don't always follow seasonals, but it gives us a pretty good idea of what should be happening. And when what should be happening isn't happening, well, that's also a good indication. We have cycles in the stock market. They can show us a suggestion of the future. I really like intermarket relationships because I do think fundamentals matter, and one market can help lead and show us where another market is going to go. I have a lot to share with you on that today. I think you're going to find it really exciting. And then, of course, there's always technical analysis. The technical tools, we've all got them out there. It's almost like reading tea leaves late at night, but technical strength and weakness can also help us tell when there's a stock market rally or decline. I've called a lot of stock market rallies in StockCharts.com. I've used technical analysis for that. So it does have value. You just have to be selective in the tools. And then finally, economic data, because economic data really matters. I'm going to show you a way cool fundamental economic tool that gives some really good buy signals as well from the Federal Reserve System. So hang on, a lot of stuff. We're going to now look at the tools of our trade. Well, here's the stock market seasonal pattern. This is from my indicator in StockCharts.com. You can see last year it wasn't so good. We had a big decline in the first part of 2020, and seasonal said we should have rallied then, when we didn't. Then when we did rally, seasonal said we should really go down, and finally we did get a seasonal low, and we did get a rally. So seasonals can be indicative, but they're not always followed. Now, where we are right here, right now, in the middle of March, towards the end of March, is usually where we see a seasonal low in the marketplace and rally up into maybe the 1st of May and then pull back a little bit. So that's the seasonal pattern of the Dow Jones Industrial Average over the last 50 years. Now, if we take a look at just the last 5 years, has this pattern shifted? Does this pattern change? Because these patterns do change. So now we're looking at the 5-year seasonal pattern. And we see that's a little different. And we follow that seasonal pattern pretty well. Notice that where we are right now is markets start to decline, then rally, and then come down. And we've had a nice seasonal low here. The important thing about seasonals, I'm going to point that out to you, is it doesn't necessarily mean the market's going to go down from here to here. It suggests this is an area of the market will go down or move sideways, and then here's a buy point. So market really didn't do much during the seasonal typical decline, and then when we got to the seasonal low, yeah, it really took off. And that's about where we are now, a little bit more to the upside. Then around the end of March, then we go into either a trading range or a down move in the market. That's been the seasonal pattern of the last 5 years. So recap of this, usually at this time of the year, stocks rally. But the last 5 years show we're more of a choppy pattern in the market at this time of the year. Can we know the future? I mean, people have been trying to figure out the future going way back to the time of the Egyptians, the time people first were here. They want to know the future. Partially it can be known, but I'm a believer, a big believer. We can't know all of the future. We can't be absolutely precise. We can get a general idea, though, and one of the things I like to use for that are cycles. How good are cycles at predicting the future? They're not bad. Here's my cycle forecast indicator in StockCharts.com. Notice it calls for a low in October, and we had it. The market should rally, another takeoff point. We had it. A little pullback in the market. We've had a pullback in the market. Now, this indicator is really fascinating. This is something I developed about 15 years ago. It's an average of the 3 most dominant short-term cycles in the marketplace. And it suggests, again, you can see what the pattern the market should follow. We should start to rally up to about now. And the seasonal or the cycle pattern, not seasonal, but cycle pattern suggests we can start to come down a little bit here until the end of May. That's one cycle forecast. This is an automatic cycle tool in StockCharts.com. You can use it for any market on a daily basis, and it's very good for the S&Ps on an intraday basis, by the way. We've had a lot of feedback from people that are using it, have reported that. I see that myself in my own trading. Now, there's another way of looking at cycles. I'm going to look at the weekly cycles here to get an idea of a longer term view of the market. And if we look at a longer term view of the market, the 146-week cycle has done a pretty good job. Market low, was big rally, big rally, big rally, big rally. So this 146-week cycle has been pretty dominant in the marketplace. So why not see what it's telling us right here, right now? Again, you can see the last 146-week cycle lows, and we have coming up around the end of May, we have a 146-week cycle low. So I think traders should really be alert for a potential buy point at that time in the marketplace. That suggests to me that we have a good ability for the market to rally. But all this cycle stuff, seasonal stuff, even technical analysis really has to be placed in consideration with what the economic and fundamental data are, because a cyclical low in a bearish environment is not going to produce a big rally. So we'll get to fundamentals in a moment. But first, I want to look at these cycles in the marketplace to get an idea of what's going on in terms of just price. Now, another way we can look at this, and this is really a cool idea, is to look at the advanced decline line. Now, the dashed line that you see on your screen here is the daily advanced decline line. That's the net number of stocks that advance or decline for the day on a cumulative basis. As you can see, this is an internal look. This is not looking at the Dow. This is not looking at the triple Qs or the S&Ps. This is looking at simply the number of stocks advancing and declining on a net cumulative basis. Big difference. Huge difference. Look in 2020 how we saw a big crash in the market, but not really much in the advanced decline line. And the advanced decline line made new highs in May, long before price made new highs. The advanced decline line has been one of the best indicators I've used way back since the 1962 time period when I first started trading. And there are cycles in the advanced decline line. Here you can see where they are. Buy point here, buy point here, buy point here, buy point over here, buy point here. So with that in mind, why not take a look at where we are in the internal cycle of the market, the advanced decline line right here, right now. We should move up a little bit higher, pull back, and around the first part of May, we come down into a cyclical low in the advanced decline line around June. Now, we just saw in price around the end of May, advanced decline line, middle of June. So this is starting to give us some perspective that we may see some weakness coming to this market. And the next really significant buy point, technically speaking here, looks like it's going to come around the middle of June of this year, middle of June, end of May. So we're getting an idea. And as I said, we don't have perfect vision in this business. If we did, everybody would be multi-billionaires trading. Nobody, and I mean nobody, has perfect vision in this business. And I know the best traders in the world. And I have tried everything and seen all the psychics and astrologers and all that stuff, especially when I was young. Spent a lot of money trying to find who had perfect vision. We all have blurred vision, let's face it. Knowing the future is difficult. Well, let's look at daily data now. I'm using just daily price action here in the Dow Jones Industrial Average. The reason I'm using the Dow Jones Industrial Average, we have more data there. This goes way back in time. So we may get a little better idea of the cycles in the marketplace using that. And I'm using the shorter term cycles here in the Dow, and you can see the market's pretty well responded to the cyclical forecast that we see here. Well, look at that, about the first week of June, middle of June, it looks like we have another buying opportunity. Now, here's the thing about cycles. Just because we had a cycle peak doesn't mean the market's going to crash. It means, oh, we're probably going to go sideways, or we could go down. That's where we have to judge technical analysis, how weak or strong is the market here. You recall from last year in StockCharts.com, incredibly bullish. So we didn't think much of the cyclical highs in the marketplace. The cyclical buys would be very positive, right? As we were here, as we were here, and over here. Remember, at the first of the year, people were so bearish on the market. We weren't. Why? Well, economics are bullish, fundamentals are bullish, and cycles say we should rally until somewhere, maybe in April, end of March, sometime in this general time period, then the next cyclical move is to the downside in the market. So let's give credit where credit is due. Those 5 prior charts you just looked at, these charts for cyclical analysis, for that I used timingsolution.com. That's the best cycle solution that I've been able to find. It's really an amazing software. Don't get anything from these people for recommending it. I do use it. And if you're really, really into cycles, it's not cheap software, but it's good software, and it's almost too much there to work with. Okay, so I do a forecast every year, and I'm going to share with you a part of that forecast report. This was written in last December. This red line was shown to my readers in December as what the market should do. Now, this is what the market's actually done. There's the forecast. Pretty good. Remember, again, so many people were so bearish at the first of this year, and they've been dead wrong as we made consecutive new highs. And there's this forecast. It's simple. It's based on something that was written about in the 1930s by a couple of authors. And all it is the average of all years ending in 1. So this would be 1911, 1921, 1931, 1941. And the 1-year pattern is pretty much what we've been following this year, isn't it? And it suggests also a decline coming up until, maybe end of May, 1st of June. The next really good buy point should be at that time period. Interesting, because all this I've shown you so far comes from different directions. We look at advanced decline line, we look at price, we look at seasonal, but we're seeing they all are starting to suggest we have a really good buy point coming up here. In the meantime, maybe a soft sideways market, or maybe even a decline in the market. But that's pretty interesting to me to see that take place in the market. Now, my actual 2021 forecast, I'm giving you a little bit of what we showed. This was the forecast made again last year in December. And it said the market should come down like this, start to rally like this, and start to really take off like this. And that's what it's done. This forecast suggests we're going to see some weakness coming in, and then we start to come down into the May time period, maybe May, June time period. So we still see on a longer term basis, this is based on lots of years of action in the Dow Jones Industrial Average, that we should see a sideways, if not pullback market, one more little up thrust, and then a move to the downside, maybe into that June time frame again. So a recap of cycles: expect the market peak in early April, leading to a bottom in early June. That's kind of a culmination of everything that we've looked at here. That's generally what seems to be going on in the marketplace. Well, I love intermarket relationships because I do think fundamentals matter. Trouble is, they're always changing. When interest rates are high, what trumps low crude prices? But when crude prices are high, that trumps low rates. So at certain times, certain things have more influence on stock prices. If we have rampant inflation, that's going to affect stock prices more than if we have low crude prices or the price of gold. So these are things that are not set in stone. We kind of have to work with. I work with them, and they can give us a nice view of the future. These intermarket relationships, what we're looking for is either strong association. Perfect correlation scares me, because if they correlate perfectly, it's probably something wrong. And then we see weak association or no association. But what I'm looking for is strong association. And one of those things that gives strong association is crude oil prices. Let me show you crude oil prices here now. Crude oil, the red line, this is simply the price of crude oil. Push forward, and I'm going to show you the push forward in a little bit. So this low in the stock market and in the red line was known in the stock market long in advance. The suggested high in the market was known long in advance. What do I mean by that? Well, let me continue showing you. This low in 2019 was known long in advance, as was the peak back here. This is what I mean by this. This red line is predicted or pushed forward excuse me, almost a year. So what you just saw, this low was known a year in advance, this high a year in advance, this low a year in advance. And here's the path that crude oil is suggesting stocks will follow. A little bit more rally in here, a pullback. Oh my, we just keep seeing that, don't we? Then a huge rally coming up. That's based on the intermarket relationship of crude oil. You have to be careful of sharks and ice cream. We can put too much attention on these. I thought you might enjoy this chart. The blue line is ice cream sales. The red line is shark attacks. Wow, look, they move right together, don't they? but I don't think there's anything in common with sharks and ice cream, other than might be that when the weather's hot, there's a lot more people at the beach. And when there's a lot more people at the beach, they're buying more ice cream because it's hot, but the sharks are out there eating people because it's warm and there's more food for them. So you have to be a little careful about causation or correlation. And I try to focus on that. One market that I think has good causation as well as correlation is gold. Here again, we're seeing the price of gold, and this red line is pushed forward. I'll give that to you in a moment, quite a bit. So we should see a market strong rally, pull back, rally again, pull back, rally, pull back in here, market goes to the upside. And here's the gold forecast. Again, this is known a long time in advance. We should have a significant market low here, pull back, short-term pull up in terms of price, which is what we had, and the market takes off again. Now here's the gold forecast. It almost looks like the crude oil forecast. It isn't, created totally different. And what we see here is the same thing. Generally speaking, we maybe go sideways for a while, but coming up, a big rally in the market. So we've been overbought in this market. We see some technical deterioration. It looks like it could be time in here that we start to see some markets start to pull back, the S&Ps and the Dow start to pull back. But we have a pretty good visibility from the gold forecast of where we're going. Now here's crude oil on a daily basis. This daily basis, crude oil is suggesting that we can rally right about right here, right now. Go back to my pointer. And then we start to come down. That April, May decline we've seen in some of the other indicators done a pretty good job of really giving us a roadmap of what to follow. Gold, the same thing. Now here's the gold intermarket daily forecast. Remember, this is pushed forward. This low, this peak was known quite a bit in advance, almost 4 months in advance. It also just suggests gold is that we can start to see the market drift to the downside in here, right about right here, right now. So recap of intermarket studies. The top's coming, long-term, still up. Isn't that great to have that visibility from fundamentals? Well, technical indicators also come to play because they can tell us how weak the market is at this time. So I look at one of the technical indicators I really like to look at is my money flow index. It is in StockCharts.com. And notice when the money flow index is high, there's been a lot of professional buying in the market and you want to be a buyer. When it's very low, there's been a lot of selling in the market like this, and you should expect a decline in the marketplace. Pretty simple. When the commercials and the informed money is buying, we're looking for buys in the market. When they're not buying, they're doing a lot of selling, we're looking for declines in the market. And so this is where we are right here, right now. They were heavy buyers in February, around the first of the year, big rally in the market. Then they stopped their buying. Oh, we declined. They started their buying again. Well, recently they've been hanging out in the area where we usually expect sideways, if not down moves in the market. That's what real money has been doing. And again, you can get that on StockCharts.com. And we look at it again, look at a little longer term basis here. We see the same thing. This is on a weekly basis. And again, we see we're in that general area when we kind of look for markets to decline or at least move sideways. That's technically what's happened with the flow of money into the market. You can use this on stocks as well. Here's Google. You can see what happens when big money is buying. Big money is buying here. Big money gets bullish here, gets bearish over here. Oh, prices don't go anyplace. Bearish here, markets decline. So you get the idea. This can be a really good technical tool for us to see what's going on in the market. Now, another thing I like to look at is a number of advisors that are bullish or bearish in the market, because when everybody is bullish, there's nobody left to buy. And when everybody's bearish, you want to be a buyer. This is a weekly chart we're looking at here, and we see that people are way too bullish. We are bullish revenue, bullish reading last time was about 92% of the people were bullish, and typically when that happens, markets decline. When everybody's really bearish back here, that was a time to be a buyer. So we'd like to see this get back into the everybody's too bearish zone for the next buy point. Maybe at the end of May, June, we will be there. And if so, maybe I'll get invited back on StockCharts.com. By the way, if you like this show, click that little thumb that says, yeah, thumbs up or thumbs down. If you don't like the show, click thumbs down. Write in there what you don't like about it. I usually respond to people as well, if I possibly can. So, thumbs up, thumbs down, that's good. It helps the people at StockCharts.com know whether they should have people like me back on the show or not. So it just makes for better content for everybody. I also like to look at accumulation in the market. This is one of my measures of accumulation, also on StockCharts.com. We're looking at a daily basis. Here are the triple Qs. Notice we went to new highs here. We didn't in accumulation. And look what happened last year as this market is declining. Look at the accumulation coming in here. The market's just peeling off to the downside, but higher highs, higher lows and accumulation all through here under massive accumulation. One of the reasons I was so bullish last year, go look at the StockCharts.com on YouTube shows that I did last year. We call the low really bullish, in part because of technical analysis. So where are we right here, right now? Well, we've made new highs in here recently in the triple Qs, but we didn't in accumulation distribution. Notice at this point, trading range, a lot of accumulation coming in. So we want to follow this index to see when they whoever they is, right, come back in on the accumulation side of the marketplace. But this concerns me that we've seen a new high in price not matched by a new high in accumulation and distribution. So recap of technical studies, some weaknesses developed. There is some weakness, some chinks in the armor here. And that kind of adds up to the idea, maybe I can go out on a limb here and suggest to you guys and gals that we are not too far away from some type of a market top with that buy point coming. Well, here's the gorilla in the room, though, economic data. Economic data provides context. It's usually not all that good for timing, but hold on to your seatbelt. I'm going to show you how it can be used for timing today. This has not been shown before. It's an index you're going to love. You can get it for free from the Federal Reserve System. And economic data is so valuable to help determine the start of bull and bear markets as well. It's really suggestive of when we're going to have a significant bear market. It doesn't time it right to the instant, to the hour, but it gives a pretty good context. Bear market's coming. So one of the gorillas in the room is the yield curve. Oh, thanks to the people at StockCharts.com, you can get this for free. Notice in 2007 and 8, when stocks were rallying, but the yield curve was flat and down. That's a bearish sign. So where are we now? Here's where we are right now, and the yield curve is up. As long as this yield curve is trending up, and it has from here all the way up, that's bullish. We start to see this yield curve turn to the downside or go flat, bearish. It hasn't. This entire rally, all these Cassandras that have been prophesying pessimism and doom and a crash, they've all been wrong, and the yield curve has consistently said, look for higher prices. Well, one of my strong beliefs about the market is that stocks are driven by consumer buying, not totally, but for the most part. So I really want to watch when consumers have money they can spend, they can buy stuff and corporations can make profits and prices will go higher. So how can we look at that? Well, we can look at job openings. The gray area is times of recession. Now notice in 2001, job openings declined, 2007-8, job openings declined. Last year, before we had the really shortest depression or recession in the history of the world, we started to see that decline. But look where we are now. We're starting to come up. In fact, if we blow that up a little bit, a larger view on it, we've been coming up real well in job openings. Jobs have been opening up, and I think they're going to continue being opening up, which means, and I'll go on record here, you're going to see some nice increases in earnings and stocks in the Dow Jones Industrial Average. That's going to help the PE ratios, but earnings are going to get better, especially in the second and third, mainly third quarter of this year. So the other side of that is unemployment claims. When people are unemployed, notice what happens, recessions, unemployment claims start to go up, recessions, they go up, recessions, they go up. This might be the best indicator of them all to predict recessions in the marketplace. And this is where it is now. It's coming down and down and down. If we blow up on it, it came up last year. Oh, we had that very quick decline in the market, but look what's happened. From May of last year all the way down, we've still not seen a turn up in unemployment claim. Now, if we do, that can give us a bear market signal, but so far, not there. Unemployment claims, these are people who are claiming for uninsurance. They want to get insurance, they want to be insured, they're out of work. That has not increased. That's very bullish. The unemployment rate, also about the same thing. Again, unemployment rate kicks up and we have recession start in the marketplace. So that's where we are now, kind of like claims. Look at this, down, 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 down. Now, if this does start to turn up, yes, that can be bearish for the market, but that's not where we are right here, right now. So the gorilla in the room is economic data. I love this. In March, a group of conservative economists warned of fiscal and economic chaos if nothing's done. The liberal economists, including Janet Yellen, said it's going to cripple the government's ability to provide for the citizens. An article in Fortune warned that the massive debt would blow up the Trump economy. Washington Post said we have a day of reckoning coming. All that was March 2018. I'm glad we didn't go short back then. I'm going out on the end of the limb, but it's where you find the fruit and also the nuts. And there are some real nut jobs in the stock market business. And the nut jobs are usually based on deficits. Here's the untold truth. I'm going to make it simple for you. What does a deficit mean? It means there's more debt. It also means there's more money in circulation. More money in circulation, people can buy more stuff. And that's very bullish for stock prices. More money in circulation is wildly bullish. More debt doesn't seem to matter because we are on a fiat currency. We're not on the gold standard. Get that out of your head. From 1962, when I first started trading, I have heard, oh, debt will kill everything. Debt will kill everything. Da, 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 da. If I would have just bought stocks and held on and never done anything, I'd be a lot more wealthy than I am now. So we're not on the gold standard. So the gold standard guys got it all wrong. If we were on the gold standard, yes, they would be right. But we're on fiat currency. It looks to me like the record of the last 60 years. It doesn't matter. The debt gets handled in one form or another. So quit acting like we're on the gold standard. Okay, here it comes, the St. Louis Financial Stress Index. Notice when this index starts to go up, recessions are coming, right? Simple. But look at this. If we blow this up a little bit and say, okay, remember this is a stress index. Stress is starting to come into the marketplace. Oh, we want to be a seller about February 2018 because we're starting to kick up. We start to come down. In other words, looking at the trend of this index, when it buy 5/11 2018, a nice buy point. By October 2018, stress is starting to release. We want to be a buyer here at 11/11, January 19. And look what happens. So you can use this as a pretty good tool for timing entries into the marketplace. Fundamental tool. And here's where we are now. The stress started to reduce itself about April last year, and we haven't seen any upturns of the market. That is bullish for us. Also, the leading index, and by the way, just to make certain you have that, this is the St. Louis Federal Reserve Financial Stress Index. And all you're going to do is put some trend lines on that. So you'll have a pretty good idea of if we're getting stress in the economy. If we are, look for sell signals in stocks. If we're starting to be unstressful, we're coming this way, it's positive. We want to look for buy signals in stocks. Okay, got it? And the leading index, look at this. The leading index didn't give a recession sell signal. It did in 2007, 2000, 1990, 1991. It did, but it continues being very bullish in here, which is quite interesting to me. Stock prices have been actually on balance still positive. New highs, new highs, new highs. People, the Cassandra's expecting to crash, and we just haven't got it. They've been so wrong. So adding it all up, if we start to add all this up and try to figure out what's going on, the way I see it, cycles and intermarkets are suggesting a sell-off in here. Fundamentals say it's not the start of a bear market. And someplace in here, we're going to see the market start to pull back and set up a sell signal. Probably we can see that when the advanced decline line is weaker than stock prices. That's going to give us a good indication of when the decline is going to happen, but it's coming. And then we should get a buy point somewhere in June, maybe late May, first part of June, maybe right after people pay taxes this year, since it changed from April to June. That might be the time period to look for it. But as I see it, guys and gals, going out on the end of the limb where you find the fruit and the nuts, you can also see that we are coming into a market decline not too far away that will set up another wonderful buy point in this ongoing bull market. The indicators I've shown today are available on StockCharts.com, and we have a lot more of them coming for stock traders and investors as well. So I hope you've enjoyed the presentation today. If you did, thumbs up. If you didn't, thumbs down. Go ahead, express your view. This is Larry Williams, as always, wishing you good luck and good trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.